January 14th, 2026. Gold just shattered $4,647 per ounce, an all-time record. The metal of kings has officially become the asset of kings. If you're an average person, you're priced out. But silver? Silver hit $91 per ounce today. Still affordable, still accessible, still within reach. And here's what Wall Street doesn't want you to know. The same setup that sent Bitcoin from $1,000 to $60,000 is happening right now with silver, but faster, and backed by something Bitcoin never had. Physical scarcity you can hold in your hand. I'm going to show you why silver is about to experience the largest wealth transfer in commodity history, why the window to buy is closing, and why what happens next could change your financial future. Let me paint the picture of where we are right now. Gold closed yesterday at $4,641 per ounce. To buy a single 1-ounce gold coin, you need $4,600 plus premiums. That's around $4,800 out of pocket. For most Americans, that's a month's rent, a car payment and groceries, half a mortgage. That's not an investment, that's a luxury. Compare that to 10 years ago. January 2016, gold was $1,100 per ounce. You could buy an ounce of gold for what silver costs today. Now, gold has quadrupled. It's crossed the threshold where ordinary people can't participate. The median American has $5,300 in savings, all of it. If they put every dollar into gold, they'd own 1.15 ounces. That's it. No emergency fund, no buffer. Everything in one asset. This is not accessible wealth preservation. This is the asset of institutions, central banks, and the ultra-wealthy. And this isn't temporary. JP Morgan projects gold hitting $5,055 by year end. Goldman Sachs says $4,900. HSBC's upside case, $5,000 to $6,000. Gold's not coming back down. The asset has fundamentally repriced. Central banks bought 566 tons per quarter in 2025. They're not selling, ever. Gold has become what it was always destined to become. The ultimate reserve for those who already have wealth, not the entry point for those building it. But silver? Silver is where gold was in 2016. Still affordable? Still accessible? Still the opportunity. Here's the current state of silver. Silver closed at $92.46 today, up 200% from January 2025, up 26% since the start of this year alone. That's explosive. That's parabolic. That's the kind of move that changes portfolios. But here's the critical part. Silver isn't expensive yet. At $91 per ounce, you can still buy meaningful positions. $5,000 gets you 54 ounces of silver. That's a real stack, a tangible position, something that matters when the price moves. Compare that to gold. $5,000 gets you 1.08 ounces. One coin, that's it. Silver gives you leverage, physical leverage. When silver moves another 50%, which experts say is coming, your stack grows with it. But this window is closing. Fast. Multiple analysts are now forecasting $100 silver. Not as speculation, as a baseline. Felipe Geisels, Chief Strategy Officer at BNP Paribas, told CNBC he would not be surprised to see silver well north of $100 in the not-too-distant future. Citigroup revised their 2026 target to $110 per ounce. Veteran technical analyst Michael Oliver projects $100 to $200 silver by early 2026. And those aren't moonshot predictions. Those are based on fundamental supply and demand that has never been this extreme. Here's where it gets serious. Silver is in a supply crisis, unlike anything in modern commodity markets. Global silver mine production peaked in 2016 at 900 million ounces. By 2025, it fell to 835 million ounces. Production is declining, not increasing, declining. Meanwhile, demand in 2024 reached 1.17 billion ounces. That's a 500 million ounce deficit. 500 million ounces consumed beyond what was produced. This is the fifth consecutive year of supply deficits. 2021 to 2025, cumulative deficit, 820 million ounces. Almost a billion ounces of silver removed from global inventories. Where did it go? Into products that destroy it. Solar panels, electric vehicles, electronics, AI infrastructure. Unlike gold, which sits in vaults and gets recycled endlessly, 70% of silver is consumed. Used? Gone. Every solar panel installed consumes silver that will never return to the market. Every AI data center built consumes silver permanently, and demand is accelerating. The International Energy Agency projects solar capacity will quadruple by 2030. Each gigawatt of solar requires silver. Unavoidable. Irreplaceable. AI data centers are consuming silver in printed circuit boards, bonding wires, and high connectivity connections. This demand is price insensitive. Tech companies cannot substitute, they cannot delay, They need the metal regardless of cost. The World Silver Survey 2025 confirms the market is in a structural breakdown. Above-ground silver stocks are at multi-decade lows. London Vault inventories, which supply ETFs and industrial users, have been drained as metal flows to Asia. In September 2025, silver lease rates spiked above 5% for the fifth time that year. Historically, lease rates were near zero. 5% means holders of physical silver are demanding premiums because the metal is scarce. This is not a temporary squeeze. This is structural, and it's accelerating. And then China dropped the hammer. January 1st, 2026, China implemented export restrictions on refined silver. China is the world's largest silver producer, and now they're restricting exports. Silver premiums in Shanghai immediately spiked to $10 per ounce above London prices. A $10 premium. That means buyers in China are paying $10 more per ounce just to get physical metal. In Japan, premiums on secondary markets hit 60%. In Dubai, 40%. Physical silver is disappearing, flowing east and not coming back. Ned Naylor Leyland, investment manager at Jupiter Asset Management, told CNBC, silver is basically disappearing now to China and India. If we continue to see this very wide spread between the price paid in Shanghai and the price on the screen in the West, then the remaining physical silver lying around should continue to head east. This is critical, because silver traded in the West on COMEX and London markets is mostly paper, contracts, promises of silver, not physical metal. But industrial users need physical silver, and when they can't get it in the West, they pay premiums in the East. This is a market in the process of breaking. Paper prices are becoming irrelevant. Physical prices are diverging. And when that gap widens enough, the paper market implodes. But here's the factor almost nobody is discussing. The one that makes this different from every previous silver rally. Artificial intelligence. AI requires chips. Advanced chips require silver. Silver is used in printed circuit boards, bonding wires, memory chip packages, and high-efficiency power electronics. AI servers cannot function without it, and AI infrastructure is exploding. Memory chip demand for AI data centers has created shortages so severe that analysts at TrendForce warn consumers to buy devices now before prices surge further. DRAM chip prices are projected to rise another 40% in the coming quarter. Manufacturers have maxed out production capacity. The next new factory won't be operational until 2027. This is not a normal supply constraint. This is a bottleneck at the materials level. Silver is the conductor, the critical material, and there isn't enough of it. Semiconductor companies are telling their customers they don't know how much memory will be available in 2026 because they don't know how much silver they can secure. Let me repeat that. Chip manufacturers don't know if they can get enough silver to fulfill orders. This is a crisis, and it's driving industrial users to buy silver at any price. This demand is permanent. AI is not a fad. Data centers are not going away. The digital economy requires these chips, which means it requires silver. And unlike consumer electronics, which can delay purchases during shortages, AI companies cannot. They're in a race. First mover advantage, strategic dominance, billions in investments that require deployment now. This is price-insensitive demand hitting a market already in deficit, and it's only beginning. Now let's talk about why this is the new Bitcoin. In 2015, Bitcoin was trading at $250. Most people had never heard of it. Those who had thought it was a scam, libertarian internet money, a fad. By 2017, Bitcoin hit $20,000. By 2021, $60,000. Early adopters made generational wealth. People who bought at $500, $1,000, even $5,000 made life-changing returns. The people who missed it, they watched. They hesitated. They waited for a crash that never came back to early prices. Silver is at that moment right now. Right now, silver is affordable, accessible, still viewed by mainstream investors as just an industrial metal, underestimated. But the fundamentals are stronger than Bitcoin ever had. Bitcoin's scarcity is artificial, code, math, digital limitation. Silver's scarcity is physical, real, governed by geology and consumption. Bitcoin has no industrial use, no central bank demand, no physical applications. Silver has all of it. Industrial necessity, investment demand, monetary history, physical scarcity. And here's the critical difference. Bitcoin's supply could expand if the network agreed. It won't, but theoretically it could. Silver's supply cannot expand quickly. It takes years to open new mines. Ore grades are declining. 75% of silver comes as a byproduct of other mining. Higher prices don't immediately bring new supply. This is the perfect storm. Inelastic supply, accelerating demand, physical scarcity, and a market that hasn't priced it in yet. But there's a trap. And you need to understand it. Most people who think they own silver don't actually own silver. They own paper claims to silver, silver ETFs, digital silver, allocated accounts that may not be fully backed. During the 2020 silver squeeze, traders discovered that paper silver markets trade at 100 to 1 leverage. For every ounce of physical silver, there are 100 ounces of paper claims. That works fine when nobody asks for delivery. But when industrial users need physical silver and it's not available, paper prices become meaningless. This is already happening. COMEX registered silver inventories, the silver available for delivery, hit decade lows in late 2025. Physical silver is being drained from vaults. London, New York, Shanghai. The metal is leaving exchanges and moving into private hands. Many analysts now warn that paper silver ETFs carry counterparty risk. If the squeeze intensifies, those who hold paper may discover their claims cannot be fulfilled. Physical ownership is non-negotiable. Real silver. In your hand, under your control, coins, bars, tangible metal. That's what you need. Because when the squeeze accelerates, paper promises won't matter. Only physical metal will. Let me be clear about timing. I'm not telling you silver will hit $100 tomorrow. Markets don't move in straight lines. There will be pullbacks, volatility, corrections. But the trajectory is set. At $91, silver is still accessible. By $110, positions become expensive. By $150, most people are priced out. By $200, which some analysts project, silver joins gold as an asset for the already wealthy. The window where ordinary people can build meaningful positions is measured in months, not years. And this isn't speculation. This is arithmetic. 500 million ounce annual deficits. 5 consecutive years. Industrial demand that cannot be substituted. AI infrastructure that requires silver regardless of price. China restricting exports. Physical inventories at multi-decade lows. The market is breaking. And when it breaks fully, the repricing will be violent. Look at gold. From $1,100 in 2016 to $4,641 today. People who hesitated missed a 4x gain. Silver is at that starting line right now. But with more volatile upside because it started from a lower base and has industrial demand gold lacks. So what do? First, understand the opportunity. This is not a typical commodity trade. This is a structural imbalance with a timeline attached. Second, act within your means. Don't overextend. Don't leverage. Don't bet the house, but don't ignore it either. Build a position. Start small if necessary. Buy ounces when you can. Accumulate. Physical silver. Coins from government mints. Bars from reputable dealers. Metal you can verify and store. Third, think in terms of wealth preservation, not gambling. Silver is insurance against the paper system. It's a hedge against currency debasement. It's a claim on real resources in a world running out of them. And fourth, understand that this moment won't last. The people who built wealth in Bitcoin bought when it was $500, $1,000, $5,000, not when it hit $60,000. The people who built wealth in gold bought at $400, $800, $1,200, not at $4,600. Silver is at $91, still affordable, still accessible, still the opportunity, but that window is closing. History shows us what happens when precious metals enter supply crises. In 1979 to 1980, silver went from $6 to $50 in months, 8x in less than a year. The Hunt brothers tried to corner the market. They failed because they used leverage, but the underlying shortage was real. From 2008 to 2011, silver went from $9 to $48, 5x in 3 years. That rally ended when economic recovery reduced industrial demand and new supply came online. This time is different. Industrial demand is structural. AI is not going away. Solar is not going away. Electric vehicles are not going away. And supply cannot respond. Mines are depleting. New projects take 7 to 10 years to develop. The deficit is locked in, and it's getting worse. Some analysts project silver could go beyond $200 if the structural shortage persists and monetary pressures intensify. That's a 3x move from here at minimum, potentially 5x, potentially more. But the real gain isn't just percentage returns. It's positioning in the last affordable hard asset before everything reprices. Roger Babson predicted the 1929 crash. Irving Fisher dismissed him. Babson prepared. Fisher ignored the signals. When the crash came, Babson was positioned to survive and thrive. Fisher lost everything. The difference wasn't intelligence, it was action. Right now, you have the same choice. You can look at the data. 500 million ounce deficits, AI demand, China export restrictions, physical shortages, analyst projections of $100 to $200 silver, and you can decide it doesn't apply to you. Metal's always correct, right? This time might be different. Or you can ask yourself, what if it's not different? What if this is the real thing? What if silver goes to $150 and you waited? What if it goes to $200 and you hesitated? What if 5 years from now you look back at January 2026 when silver was $91 and think, that was the moment, and I missed it. The window is open right now, but it won't stay open. Gold just crossed $4,600. It's beyond reach for most people. Silver is at $91, still accessible. But for how long? Bitcoin went from $1,000 to $60,000. People who bought early changed their lives. People who waited watched. Silver is at that moment. The fundamentals are stronger. The supply crisis is real. The demand is locked in. This is the last affordable hard asset before everything reprices, and the clock is ticking. If this video opened your eyes to what's happening right now, subscribe. Because what comes next in the silver market will be historic. The greatest wealth transfer in commodity history is underway. Now you know why. What you do next is up to you.